You can't have your cake and eat it too. Yes, you heard that right, and probably the Indian lawmakers too. That's why, despite having 5 broad categories of private trusts under the Indian Trust Act 1882, the Revocable Trust is the one that supports the settler or the contributor the least. How? Let's deep dive in today's video. So today I shall be drawing a comparative between the revocable and irrevocable trust based on 3 main criteria: control, taxation and asset protection. Because believe me, these are the 3 practical things that actually decide the robustness of your trust deed. So under the revocable trust, the settler retains full control on assets, and the settler can actually revoke the asset transfer, amend the trust deed or retrieve the assets back, since his rights to this extent are reserved in the trust deed itself. On the other hand, under an irrevocable trust deed, once the assets are settled, they belong to the trust. On taxation front, under revocable trust, all incomes are clubbed into the settler's personal return, since the trust structure is almost invisible to the taxman, since the settler owns the assets directly. On the other hand, under the irrevocable trust, the trustee becomes the representative assessee. So if you are serious about your wealth preservation and you are using a revocable trust for your asset protection, then you actually have no protection, zero. Because the assets are legally yours and hence the trust structure cannot protect you from creditors, courts and decree holders. So what do India's top business families actually do? They run a specific irrevocable trust for investments, wherein the income is split across the beneficiaries at lower slab rates. They hold business shares through the trust, avoiding probate, sidestepping succession dispute, and they keep the discretionary trust structures only for genuine wealth protection. So how are you planning to preserve your wealth? Do comment your thoughts.